Hey guys, welcome back. You're still tuned into Trading Hour, and let's start talking with our management now. We have Latent Analytics on our radar. The company delivered strong revenue growth for the second quarter. The margin performance was also quite steady this time around. In fact, if you take a look at the past 3 quarters, they've managed to sustain revenue growth at over 35%. This is ever since their listing, so that figure is up on your screen. So let's get chatting with the Chief Executive Officer of Latent Analytics. Rajan Sethuraman joins us now. Mr. Sethuraman, good morning and thanks a lot for joining us. This is Pavitra. My first question to you is on the revenue itself. You've done 40% this quarter. Do you think this level is sustainable? Do you expect higher than this? What should we expect going forward?
Good morning, Pavitra, and thank you for having me on the show. We had a very strong quarter, and as we have been giving guidance before, we expect to exceed the industry performance by a significant margin, as has been demonstrated in the last 3 quarters. So while people are talking about macroeconomic headwinds at this time, we have continued to see robust demand for our services, and that's reflected in our performance. At this point in time, I wouldn't be able to give guidance, but we don't see any headwinds which are of significant consequence at this time. So I'm expecting that we'll be able to maintain this trajectory in the next few quarters.
Okay, that's a very optimistic statement. You're saying you continue to grow higher than the industry and things are looking better from here. The last time when we spoke to you in August, Rajan, you did mention that the deal sizes are getting bigger. So from an average of around $0.4 to $0.5 million, your deal sizes have gone to $1 to $2 million. Since then, since August, how has the trajectory been and what is the visibility in terms of deals?
So this quarter we actually added 5 new accounts to our portfolio, and interestingly enough, we had the first $2 million plus single contract in annual revenue this quarter. This is the first time that we have done this. So while we have large accounts where cumulatively across multiple contracts we are far in excess of $10 million, this is the first instance where we had one SOW, statement of work, which exceeded $2 million in annual revenue. So I think the trajectory is along the lines that I indicated earlier. So even with the remaining 4 accounts, we have seen a positive trend in terms of increasing deal sizes. The one thing though is that larger deals will typically involve a larger ecosystem of constituents and participants from the client side. So some of the times the deals take a little longer than anticipated, but we are not worried by it because the effort is rewarded with larger deal size at the end of the effort.
So just to follow up here, since you're saying that you signed your first large $2 million contract and deal sizes in general have gone up, you had earlier hinted for a FY23 revenue target of around 500 crores. It was not a hard guidance, but do you think you can do better than that, given that the size of the deals have gone up?
So I think at this point in time, our run rate is already better than that number. So I wouldn't be. I would hope that we'll be able to maintain that trajectory and we should be able to exceed that number. I'm not going to put out a guidance in terms of how much we will exceed that by, because of course all of us are aware of some of the uncertainties in the macroeconomic scenario. But as I said earlier, going by conversations and deals in the pipeline at this time, I'm not worried about getting past that number at this time.
Hi, Mr. Sethuraman. Morning. Your margins had declined in Q1 because of the wage hike impact. In Q2 as well, they're closer to those levels. When do we expect them to bounce back to those 34-35%?
So as we have mentioned in the past, our margin range that we are comfortable with is in the 25 to 28% range. So while we had those supranormal margins during the COVID period, you would understand that much of it is also on account of reduced travel and marketing spends at that time. And that is not a level at which we want to sustain. More importantly, given the market opportunity, and the growth that is possible, even if we were able to generate margins higher than 28%, we would want to take it and flow it back into the business to drive growth. So that is our primary objective at this point in time. So the guidance will continue to remain in the 25-28% range at this time.
Okay. Mr. Sethuraman, you'd also mentioned that you want to keep aside, around 150 crores for acquisitions, and you are looking at, finding something attractive. Have you come across anything yet? And is there any kind of inorganic growth on the cards?
So actually, over this quarter, we went as far as a letter of intent and due diligence on a couple of opportunities, which means that we actually spent considerable management time and effort in evaluating those opportunities, but unfortunately they didn't pan out for a variety of reasons. We are just being extra careful at this time, given that this is the first acquisition, and we want to make sure that it is accretive, right, to the company that we are acquiring, as well as all investors and shareholders from a revenue and margin perspective. So cultural fit and the ability to sustain the growth momentum is very important for us. So we have since then engaged 2 external partners to help scout for opportunities, and we already have another 10 on the table at this time, right, that we are evaluating. I don't want to put a timeline to when we will close our first deal, but we are hoping that we'll be able to see some significant traction in the rest of the fiscal and get close to closure when the end of the fiscal comes around.
That figure is still correct, that you're looking at around 150 crores? Is that what you've earmarked for acquisition?
No, actually it's a much larger number. If you take a look at the money that is available from the IPO plus our own cash reserves, we are almost sitting on about 1,000 crores, right, of capital. So while obviously we won't look to use all of it from an inorganic standpoint, the kitty that is available is much larger. And that is good news, because we can actually look at substantial opportunities, right, which can actually help us hit the ground running from a revenue as well as margin perspective. So that is the intention, meaning that can we achieve a step change while maintaining the growth and the margin trajectory. So that is the main criteria. We want stickiness. We want, especially we are keen on opportunities that will help us focus on our specific areas, Europe as a geography, PFSI and retail as industry segments, and data engineering and supply chain analytics, right, as horizontal. So these are the ones that we are focused on. And we do have good opportunities on the table at this time.
Okay, this is important. So your acquisition could be much larger than 150 crores you're saying, and you're sitting on about 1,000 crores of cash. Have you factored this into your 500 crore plus revenue target for this year? You said you will far exceed that, but you don't want to tell us by how much. But do you think some amount of these acquisitions could get factored into this fiscal, or it's too early? You're looking at it.
This fiscal might be too early,
okay.
Because even if we were able to identify and move towards closure, by the time we do the closure, I don't think we'll be able to consolidate much of the revenue in this fiscal itself. So the intent right now is to flow a lot of investments into the right channels from an organic growth perspective. So the 500 crore plus number that you mentioned and going past that will also be driven by the investments that we have already started making, right, in all those focus areas that I mentioned. And that is expected to pan out for this year.
Okay, so what is the organic plus inorganic compounded growth target that you have, say, for the next couple of years? What could an average growth look like for Latent?
So organically, we had indicated that industry plus kind of a growth rate. So last year we did 33%. This year we are on target for a 25 to 30% kind of a range. We believe that we can sustain that organic growth trajectory. Now, as I mentioned earlier, the inorganic acquisitions will help create a step change so that we are able to add substantial numbers, right, to the top line and bottom line, but maintain the trajectory from a growth perspective from there on. So the inorganic should give a clear lift, right, if you do that and integrate and synergize well. So that is the plan. So there will be that 25 to 30% growth trajectory, but hopefully there will be a step change on that as well, right, as we go forward with the acquisition.
Okay, we leave it at that. The street likes what they're hearing. The stock is up about 4%. Rajan, thanks a lot for being with us on CNBC TV 18. That's Latent View. They're saying that demand is very robust. They continue to grow higher than the industry. They're targeting 25 to 30% organic growth in just this fiscal, sitting on over 1,000 crores of cash and looking for some inorganic moves as well, some acquisitions that they plan to close very soon. Let's slip into a quick break.